Motley Fool is pitching an AI agent stock, which they say is part of AI's third wave. According to them, third wave stocks can grow as much as 28,000% and reach almost 70,000%. I reveal the stock here for free so you don't have to buy their newsletter. No paid or proprietary info is given away here. It's all guesswork based on clues in a publicly available email. Let's quickly look at the Fool's recent track record first. They recommended EQT back in July 2024, and it's been an excellent stock that has also paid a nice dividend. They recommended ASML in August 2024, and that was a bad time to recommend it. They recommended 3 stocks in September 2024, and the first was Amazon, which has done decently well. Alphba was the second stock, and it's up slightly. The last of the stocks from September was Meta, and this stock has done well. In November 2024, they recommended Lincoln Electric, and the stock has been up and down, but is basically break-even. They also recommended BWXT in November, and that stock is up too. Let's shift back to the presentation and figure out the stock now. Here's what's said in the email. I spent most of my time at the huge CES tech show in Las Vegas, checking out what Microsoft's boss says will replace all software, because I wanted to see how individual investors might possibly take advantage of what's being called AI's third wave. Think of it this way. The first 2 waves of AI created fortunes. First came the hardware revolution, sending companies like Nvidia soaring. Then the software wave hit, as ChatGPT ushered in the era of generative AI. But now the third wave is beginning, and it could dwarf everything we've seen so far. Gartner just named it their top overall tech trend for the year ahead, from Bill Gates to Jeff Bezos, to Microsoft CEO Satya Nadella, who predicted the end of business software as we know it on the BG2 podcast. This rapidly emerging third wave AI trend is on the tip of everybody's tongue. Industry experts are now predicting this third wave of AI will grow at an annual rate of 44% through at least 2032, which works out to 27x returns within just 8 years. He continues and says, what is this third wave that could replace all software? And how can investors potentially take advantage of it? We have wave number 1, AI hardware, and wave number 2, AI software. So what's the third wave? It's something called AI agents, which you've probably heard of by now. You can think of these agents as digital AI workers, independently handling complex tasks that once required teams of skilled professionals. At CES, I saw how an AI agent from sourcing GPT can manage global supply chains, cutting 250 hours of work down to minutes, and another from Obo World that's already conducting job interviews and managing HR tasks. The AI agent can have actual conversations with candidates and make hiring recommendations. And another from Coder AI, which can build entire websites and apps from simple voice commands, by people with zero coding experience. Here's the clues the Fool left us to figure out the stock. Develops AI tools and strategies for over 900 businesses. Has a prestigious client list that includes Walt Disney, Alphabet, Google, and Coca-Cola. Has grown revenue at an amazing 30% annualized rate over the last decade. Based on these clues, I'm confident the stock is Globant, ticker GLOB. Globant is a global technology company founded in 2003, headquartered in Buenos Aires, Argentina, with a presence in over 20 countries. It specializes in digital transformation and IT services, helping businesses design, build, and scale innovative software solutions. The company focuses on areas like AI, cloud computing, data analytics, and user experience, serving industries such as finance, healthcare, media, and retail. Here's the 10 things to consider about this stock, and after I'll tell you if I'd buy. Globant has established itself as an AI-first company, doubling AI-powered revenues year over year. This strategic positioning differentiates the company from traditional IT service providers in an increasingly competitive market. The company's enterprise AI platform and dedicated AI studios serve as twin pillars driving the future project pipeline, creating additional competitive advantages in client acquisition and retention. Revenue reached $611 million, showing year-over-year growth but falling below market expectations. Economic uncertainty and delayed client spending have created headwinds, particularly in North and Latin American markets. Concerns remain about whether the current slowdown represents a cyclical fluctuation or a more structural challenge to Globant's growth model. North America remains Globant's dominant market with only 5% year-over-year growth in the first quarter of 2025, significantly below historical double-digit rates. Latin America has stagnated with flat performance, while EMEA and Asia Pacific together constitute less than 20% of total revenue, highlighting geographic concentration risk. Over one-third of Globant's revenue comes from just 10 clients, creating both stability and concentration risk. A single client represents 8% of total revenue, raising concerns about potential business disruption if this relationship changes. The majority of revenue is distributed across a broader client base, providing some diversification. While this concentrated client base provides revenue stability, it also creates significant risk if key accounts reduce technology spending or shift to competitors. Acquisitions have been a cornerstone of Globant's expansion strategy. In the past 12 months alone, the company has acquired 4 companies with total investment exceeding $150 million. These strategic purchases have enabled Globant to rapidly enter new vertical markets and geographic regions that would have taken years to develop organically. The key risk is integration challenges could potentially dilute margins if acquired companies aren't smoothly incorporated into Globant's operating model. Adjusted operating margin in the first quarter of 2025 stood at 15.2%, reflecting a gradual decline from 16.5% a year earlier. This compression stems primarily from industry-wide wage inflation for technical talent and increased investments in AI capabilities and research. Globant maintains a relatively strong balance sheet with more cash than debt, providing flexibility for future investments. The company's consistent free cash flow generation supports ongoing strategic initiatives, including acquisitions and internal development of AI capabilities. Globant's workforce now exceeds 30,000 employees globally, but rising attrition rates signal challenges in talent retention amid a competitive market for technical expertise. Globant faces competition from larger firms like Accenture, EPAM, and Cognizant in digital transformation and AI services, all of which have significant resources to invest in emerging technologies. Economic uncertainty is driving clients to demand more value from technology investments, potentially squeezing Globant's pricing power and margins. The global competition for AI and digital transformation talent continues to drive wage inflation, potentially impacting profitability if billing rates cannot keep pace. Rapid changes in AI technology could outpace Globant's ability to adapt, despite its AI-first strategy, creating risk of falling behind more nimble competitors. Globant's current valuation reflects high growth expectations, trading at a premium to many IT services peers. This premium valuation leaves little room for execution missteps or growth disappointments. So what do I think of the stock? Personally, I believe the sector as a whole will keep growing. In simple terms, Globant helps large companies build digital technology, things like apps, websites, and AI tools. AI is clearly here to stay, and companies are only going to adopt this technology more and more as time goes on. Like the Motley Fool pointed out in their email, a single agent app can take 250 hours of manual work in logistics and get it done in just minutes with AI. Just think about how much time you save using ChatGPT compared to traditional search engines like Google. Businesses are definitely going to want to harness this kind of efficiency for themselves to save both time and money. That's why I can see the appeal and the need for services from a company like Globant. There's real demand for what they offer. However, I just don't think Globant is a stock worth buying right now. Their growth is decent, but nothing spectacular, and they recently underperformed. The stock has lost a lot of value since then. The real problem is that it doesn't look like things will turn around for them in the near future, so I don't expect the stock to do well. Like I said though, I do like this sector a lot and think there's stocks worth investing in. I personally think Kyndryl Holdings is a much better stock. Spun off from IBM in 2021, Kyndryl operates in the same IT services space as competitors like Globant, but with significantly more upside potential based on recent performance and future outlook. Kyndryl generated $3.8 billion in revenue, exceeding market expectations, and has a strategic focus on building adjusted free cash flow. The company has outlined a clear path toward reaching $1 billion in cash flow by 2028. Globant delivered modest 7% year-over-year growth in Q1 2025, but lowered its full-year guidance to approximately 2% growth. As a result, the stock has plummeted over 50% from its early 2025 peak. Kyndryl's performance demonstrates operational excellence and strategic execution, while Globant struggles with slowing growth and diminishing investor confidence. Kyndryl's forward PE ratio of approximately 19 aligns with sector average, providing a reasonable entry point for investors seeking growth without premium pricing. Consistent revenue performance that exceeds market expectations, demonstrating operational strength and effective business strategy execution. Clear strategy to build adjusted free cash flow with a projected path toward $1 billion by 2028, offering long-term financial stability. For technology investors seeking growth at a reasonable price, Kyndryl represents an opportunity to invest in a company with solid fundamentals, improving financials, and a valuation that hasn't yet priced in its full potential. And don't forget to click the link in the description to check out Alphba. Right now they're running their biggest sale of all time, and you can get $100 off this amazing service. Remember, I've reviewed over 100 stock picking services, and this is the only one that consistently beats the market, nearly tripling the returns of the S&P since inception. So again, make sure to click the link in the description and get $100 off this incredible deal.